In the history of global finance, nothing compares to the speed and savagery of the 2008 global financial crisis. We were told for decades that the system was resilient, that its very complexity, its endless layers of trading and insurance, was a defense. Like a network of bulkheads on a massive ship, a problem in one compartment would be contained. But on a quiet afternoon in September 2008, the unthinkable happened. A small leak, the failure of a few thousand poor-quality home loans, not in Manhattan, not in London, but in places like Sacramento and Tampa, did not just sink one bank. It instantly triggered an instantaneous, worldwide panic that threatened the solvency of every major financial institution, from New York to Frankfurt, from Tokyo to London. The core mystery of 2008 is this: how did something so local, a homeowner defaulting on a single sub-$200,000 mortgage, become something so global, so systemic, that it required the greatest government bailout in history? The financial system didn't contain the shock. It amplified it. The supposed defense, the complexity, was, in reality, a hidden weapon. It converted a localized credit problem into a systemic global contagion. This is the story of a delayed action time bomb, a failure of engineering that begins with boundless greed and ends with a terrifying realization that the architecture built to manage risk was, in fact, the architecture of failure. This is the story of the subprime mortgage, the CDO, the shadow bank, and the one catastrophic design flaw that linked them all, transforming a U.S. housing bust into an instantaneous global liquidity crisis. To understand the 2008 time bomb, you have to understand the climate it was assembled in, the era known as the Great Moderation. From the mid-1980s until mid-2000s, inflation was low, volatility was subdued, and economic growth was steady. Central banks, keen to stimulate further growth, kept interest rates artificially low. This was the first crucial ingredient. Low rates created a relentless, desperate hunt for yield. This fueled a boundless, almost religious faith in one core assumption: that housing prices in America would never decline nationally. This was a foundational lie upon which the entire catastrophe was built. This set the stage for the invention of the crucial mechanism, the subprime mortgage. These loans were extended to borrowers with limited creditworthiness, often featuring attractive teaser rates, a very low initial interest rate for first 2 or 3 years, that were guaranteed to reset, sending payments soaring and triggering mass defaults. But why would a lender write a loan knowing it would likely default? Because they became a risk distributor through the originate-to-distribute model. A lender would originate a low-quality loan, collect a massive fee, and immediately sell it off to an investment bank. They pocketed the profit and eliminated any incentive to ensure the borrower could actually repay. The risk was passed to the market. The journey of a single bad mortgage from a suburban street to a European pension fund happened in 2 crucial, engineered layers. The first layer was the mortgage-backed security, MBS. An investment bank would pool thousands of these subprime loans together and then, crucially, slice this pool into distinct levels of risk and reward, known as tranches. The senior tranches received the highest credit ratings, often AAA, because they were the last to suffer losses. The riskier junior tranches absorbed the first defaults, offering high yield as compensation. The second layer was a collateralized debt obligation, CDO. A CDO was designed to take the most volatile pieces, mid to low-rated tranches from multiple MBS deals, and repackage them together. Banks essentially resecuritized the residual, concentrated risk. The assumption was that this would diversify the risk. This assumption was lethal. The process did not diversify the risk. It concentrated the correlation of risk by packaging only low-quality tranches that all derived their value from a single underlying factor, the price of U.S. housing. The CDO creator ensured that when that single factor began to decline, every component of the CDO would fail simultaneously. The rating agencies paid by the banks issuing these instruments assigned high ratings, often AAA, to these new CDO senior tranches, legitimizing these complex, correlated failure bombs for sale across the world. The stage was set. The credit problem was loaded. But the trigger that made it systemic and instantaneous was how banks chose to fund their CDO holdings. In 2007, the teaser rates reset. Defaults went parabolic. U.S. housing prices began their irreversible decline. The value of the underlying MBS and CDOs evaporated. Banks were forced to mark to market, revealing immense losses. The global transmission mechanism operated entirely outside the traditional regulated banking system. Within the shadow banking system, international banks, seeking yield, structured their highly rated CDO tranches as asset-backed commercial paper, ABCP. ABCP is a short-term debt security, often maturing in as little as 1 to 90 days. Banks were funding long-term assets, CDOs backed by 30-year mortgages, with extremely short-term debt that had to be refinanced or roll over every few days or weeks. This is a catastrophic flaw. Maturity mismatch. When the true quality of the CDOs was revealed, confidence evaporated. Investors refused to roll over the ABCP. Banks that were relying on this short-term cash flow instantly lost their funding. They were solvent. They owned assets, but they were not liquid. They had no cash. This triggered a mass, instantaneous liquidity freeze. The failure of long-term credit risk, the bad mortgages, was transformed through a maturity mismatch of the shadow banking system into an immediate, systemic cash flow failure. The panic culminated in September 2008. The failure to rescue Lehman Brothers on September 15th caused interbank lending to freeze entirely. The true, terrifying complexity was revealed in the bailout of AIG, American International Group. AIG was a systems insurer, having written over $440 billion worth of unregulated credit default swaps, CDS, insurance policies on CDOs globally. If AIG failed, every major financial institution in the world would be forced to write down hundreds of billions in expected payments. The CDS was a final, invisible thread that linked nearly every major financial institution globally into a single, interconnected web. The U.S. government injected nearly $182 billion into AIG, not to save the company, but to save its counterparties. The system had become too interconnected to fail. The crisis demonstrated the profound internationalization of U.S. housing risk. European banks suffered massive losses due to their reliance on CDOs and the ABCP model. Even conservative German banks, bypassing their domestic prudence, funneled capital into the shadow banking system to purchase the speculative U.S. instruments in the relentless hunt for yield. Governments responded with massive fiscal intervention, including TARP, and central banks introduced near-zero interest rates and unprecedented quantitative easing, QE. Global regulation shifted. The Dodd-Frank Act aimed to increase capital and regulate the derivatives market. Basel III introduced stringent liquidity standards, a direct response to the ABCP/maturity mismatch disaster. The world finally recognized that systemic risk is not about the size of a loss, but the catastrophic flaw in the design of the architecture. However, the story does not end with a stable, fixed system. Rules like the Volcker Rule, designed to separate speculative trading from commercial banking, were persistently lobbied against and eventually softened, illustrating the financial sector's cyclical tendency toward regulatory capture and forgetting of past crises for short-term profit. Today, the systemic risks have not disappeared. They have simply migrated. While regulated banks are safer, much of the crucial function of a bank, maturity transformation and credit extension, has moved back into the shadow banking system, fintech, private credit, and hedge funds. This modern shadow banking sphere lacks the capital buffers and the stringent regulatory oversight of traditional banking, mirroring the pre-2008 environment where risk was pushed off balance sheet. Estimates suggest the global shadow banking sector has grown to an estimated $50 to $60 trillion. The enduring lesson of 2008 is about the fundamental, catastrophic flaw in the design of the architecture. The three clear takeaways that must guide our understanding of the system today are: 1. Risk is not diversified. It is correlated. Complexity does not contain risk. It concentrates it. 2. Liquidity is king. Solvency is meaningless without liquidity. The speed of a crisis is dictated by the speed of funding withdrawal. 3. Regulation follows risk. The financial sector will always innovate to escape regulation. The moment one risk is contained in the regulated zone, a new, unregulated market will emerge to house the next great gamble. The challenge is ensuring that new financial innovation does not become merely a new, sophisticated vehicle for risk concealment.